Ever wondered how some folks make millions from stocks? The stock market might seem like an alien territory filled with confusing jargon and charts that make your head spin. But here's the deal, investing in stocks isn't rocket science. You don't need a mountain of cash to get started, and it's not as complicated as it appears. So, if you've ever thought, how do I even buy stocks? Or can I really make money from the stock market? You're in the right place. But before we dive in, don't forget to hit that subscribe button and give this video a thumbs up. Stick around until the end, we've got a game-changing tip for you. Let's begin. What are shares? Let's imagine you're starting your own business from scratch. At the beginning, you own the entire business, 100% of it. But if you want to grow quickly, perhaps by expanding to more locations or hiring a team, you'll need some cash. One common way to get that quick infusion of money is by selling shares of your business. This essentially means giving away a portion of your 100% ownership in exchange for upfront funds. Now, think of a share as a slice of ownership in a company. The more shares you have, the larger your ownership stake. Many business owners are open to selling shares because it helps them raise more money, enabling them to build a much bigger and more valuable business. On the flip side, investors are keen on buying shares in companies they believe will thrive and increase in value, allowing them to eventually sell those shares for more than what they paid. Here's where the business owner faces a choice. There are two ways to sell shares: privately or publicly. Private sales involve pre-arranged deals with specific investors, as seen on shows like Shark Tank or Dragon's Den. On the other hand, public sales happen on the stock market, where anyone can buy shares. The stock market is essentially a marketplace where shares in publicly traded companies are bought and sold. Big names like Apple, Microsoft, and Tesla are all listed on the stock market, allowing individuals to own a tiny fraction of these major businesses. But why would you want to own a small piece of a company? It's simple: to make money. The idea is that as the business grows, the value of your shares increases. The goal is to buy shares when prices are low and sell them when prices are high. Now, how are share prices determined? It boils down to supply and demand. If positive news about a company surfaces, such as a successful product launch or stellar financial results, demand for its shares rises, causing prices to go up. Conversely, negative news or loss of confidence in a company can lead to a drop in share prices. Tesla serves as an interesting example. Some argue its stock should be lower based on traditional measures, but strong investor confidence in Elon Musk's vision has kept demand high, driving the price up. The dot-com bubble of the early internet era provides a cautionary tale. Excessive demand and hype led to inflated stock prices, but when reality set in, the bubble burst. How do you buy a stock? Alright, so far we've been talking about the stock market like it's one big entity, but technically there are numerous stock exchanges worldwide. In the US, there's the New York Stock Exchange and the Nasdaq. In the UK, there's the London Stock Exchange, and the list goes on for other countries. When a company decides to sell its shares to the public through an initial public offering, it picks a stock exchange to list its company on. In the past, this decision was more significant because stock exchanges were physical places where people actually went to buy shares in person on a trading floor. Back then, you'd receive a physical stock certificate for your purchase. However, thanks to the internet and technological advancements, buying shares is now as easy as a few clicks online. No need to talk to anyone, and everything is tracked electronically. Most people use free trading websites or apps to dive into the world of stocks. In the US, popular platforms include Robinhood and Webull. In the UK, there's Trading 212. Regardless of where you are, a quick Google search will reveal similar options. Once you register and deposit funds, you can start browsing available stocks and make investments. While such platform might have its own look, the core features are consistent. You'll see stock symbols, which are abbreviations of the stock names. For example, Netflix is NFLX. When you click on a stock, the platform usually provides a graph showing how the stock price has changed over time. If not, you can search company name stock on Google for the same information. When you're ready to make a move, the platform will ask you if you want to buy or sell, the quantity you want, and the type of order you want to place. A market order means you want to execute the order immediately at the current price. Alternatively, a limit order allows you to set a specific price at which you'll buy or sell, and the trade will happen automatically once that price is reached. However, there's a catch with limit orders. If the price you set is never reached, the order won't happen. You can cancel the order anytime before the set price is reached though. So it's like telling the platform, hey, make this trade for me when the price hits a certain point. Now, armed with this info, you can start buying and selling stocks. But before you jump in, there are some key things you should know to actually make millions in the stock market. Making money from the stock market. When people talk about the stock market, it's essential to understand that various types of trading are happening, each with distinct characteristics. Firstly, there's day trading, where individuals buy and sell a stock within a very short time frame, sometimes just hours or minutes. While quick profits are possible, research suggests that a significant majority of day traders end up losing money. Statistics show that around 80% of day traders quit within the first 2 years, and only a small percentage achieve long-term success. Another approach is a more long-term strategy, where you buy shares in companies you believe in and hold on to them for months or even years, anticipating growth over time. This is the strategy employed by legendary investor Warren Buffett, but it requires meticulous research and analysis, something challenging for the average person, especially when competing against large hedge funds with dedicated teams of analysts. Then there's a third option, which is often more profitable and less risky: index funds. Instead of navigating the complexities of individual stock selection, an index fund allows you to invest in a broad range of top companies simultaneously. Examples include the S&P 500, tracking the 500 largest US companies, and the FTSE 250, covering the top 250 UK companies. With index funds, you can diversify your investment efficiently. The average annual return for index funds generally falls between 6 to 10%, which might not seem like a lot compared to riskier investments, but it outperforms traditional savings accounts, which often yield less than 1% interest. Index funds provide a reliable and passive way to make consistent money in the stock market. You can set up a systematic investment plan, contributing a certain percentage of your income each month and letting it grow over time, benefiting from the power of compounding. Of course, whether index funds or riskier individual stocks suit you depends on your risk tolerance and financial goals. It all comes down to your personal risk versus reward ratio. To help you in making decisions, here are 5 final considerations. Don't invest in impulses and emotions. A bunch of folks, just like you, get drawn into buying stuff because they're afraid of missing out on something cool. We call it FOMO. It's like when you spot a hot deal and grab it, thinking you're on top of the world. But oh, what happens next? The price takes a nosedive, and suddenly, panic mode sets in. Here's the thing, if you hang on to your shares without hitting that sell button, you're not in the red. It's all about weathering the storm. Stick with your gut feelings about the company, and you'll find that when the prices play hopscotch and drop low, that's actually a golden moment to dive in and grab some more shares, kind of like buying the dip in the roller coaster of the stock market. Only invest what you can afford. When you dive into the stock market, it's like a financial adventure, but remember, only throw in what you won't miss. Think about it like this: put a small chunk of your monthly cash into the market playground. It's like giving your money a chance to grow and have some fun. Keep a stash aside for emergencies or quick cash needs. Picture this: the market is a roller coaster. It may go down for a bit, but it always comes back up. That's where index funds shine. They're like the cool kids who know how to handle the ups and downs. For a chill approach, toss your cash into mutual funds and forget about it for a few years. But if you need quick cash, maybe the stock market isn't your speed. Be wary of scammers. Watch out for scammers promising surefire ways to rake in big bucks from the stock market. If these folks were stock market wizards, they'd be busy multiplying their own money, not selling you schemes. The same goes for groups hyping up specific stocks. Often, they're just inflating prices to sell their own stash and pocket some gains. While it's smart to tune into various sources for market insights, bear in mind that nobody can nail the perfect market timing. It's like trying to predict the weather, a bit unpredictable. Stay sharp, stay skeptical, and remember, there's no one-size-fits-all secret to stock market success. Sip success with dollar cost averaging. If you've got a chunk of cash ready to take the stock market plunge, here's a smart move. Go for dollar cost averaging. Instead of tossing all your money in at once, spreading it out over a few weeks is like playing it cool. Imagine this: today's stock price might be on a wild roller coaster, and if you jump in at its peak, you might pay more than it's worth. By pacing yourself, you smooth out the bumps and snag a more average price. So think of it like sipping a good cup of coffee. Enjoy it gradually, and it'll taste just right. Understand, investing is not gambling. Sure, investing has its risks, but it's not a game of chance like gambling. When you invest, you're not just rolling the dice, you're contributing to the overall wealth of the economy. It's like putting your money into something that's actively creating more value and prosperity. It's not a zero-sum game where one person's gain is another's loss. I believe more folks should get a taste of the stock market action, especially from a young age. I get it, the idea of investing might seem a bit overwhelming initially, But if you take a second look at the key parts, you'll realize that investing isn't an exclusive club for the wealthy anymore. Anyone, yes, anyone can dive into the stock market and potentially turn their home into a money-making hub. How would you describe your experience level in stock market investing? Let us know in the comments below.